Hey guys, my name is Derek Morrell with ADPI Insurance. So yes, we do have insurance here. If you're not aware of it, we are starting to throw more content. We have some really, really cool things going on. We've already helped a bunch of folks. So today I just wanted to talk about demystifying life insurance, and also I wanted to give a grave warning about something in the life insurance industry. I think everyone needs to know about it. Everything I say today, of course, this is from my opinion. I'm happy to talk offline with anybody. You can message me if you so desire. But today I just want to dive into some of these issues here. We're just going to do a 30,000 foot view. We won't go super deep, but I do want to get this information out because a lot of people are confused on this, and rightfully so, because agents have a lot of information that they don't share with people. So let's check this out as we continue on. All right, now I'm going to hit this one really quick because we all either have it, we've had it, or we know a lot about it. This is called term insurance. It's the most familiar. Some of us get it with work. Some of us buy it. And it's pretty cheap insurance, and you get a insurance policy that lasts a period of time. Maybe it's 10 years, 15, 20, even some last 30 years. And once that period of time is done, you will either have to pay a skyrocketed amount for the same insurance, or it's gone. So if you have a 20-year term and it's 20 years in one day, typically you're not going to have insurance anymore. So that's term insurance. That's the easy one. Everyone knows all about that. Now, real quick, I talked about term. I just want to mention this. There are some great things you can do with term as far as a strategy. So with the companies we use, if we do a term policy for someone, they can actually convert that into whole life later. Now, I'm not going to get into the weeds here. This is a whole other topic. Maybe I'll do another episode on this. But what it's doing, it's locking in the medical exam on the time you have the term. So if you want to convert that 5 years from now, but there's a health issue that normally you wouldn't be able to be approved anymore from a life insurance company, it's based off of the approval on the day the term was issued, which is massively, massively huge. Again, we'll delve into that another time, but I did want to at least mention that a little bit before we move on here. Now, let's talk about permanent life insurance. So think of this. Term is renting life insurance, and permanent life insurance is buying it for the permanent duration of your life. So long as you're paying premiums, it will last your entire life. So I want to break this down simply with an umbrella. So imagine an umbrella, and you have certain things under the umbrella. This umbrella is called permanent life insurance. So we have variable life insurance, variable universal life insurance. We have indexed universal life insurance. And then we have whole life insurance. So let's go through these one by one. All right, now let's first talk about universal life. So as you saw, we have universal life, variable universal life, and also index universal life. So think of universal life. Some of the pros that someone might say is, look, it's not as expensive, and you might be able to make more in your policy or something like that. And the problem is the guarantees. And we're going to talk about that when we get into whole life. But the guarantees aren't really there. And if it's just a plain universal life, I don't personally know many people at all that have that. I'm sure there are, but not in the world that I'm in right now. What I see a lot of is index universal life. But just to tell you what variable universal life, that is it's still flexible. It has some flexibility. You can change some things. The problem is when you change, say, the death benefit or the premiums, it can rearrange your policy and the costs of your policy. So variable universal life, imagine having a pile of cash, essentially like a savings that you can access, and you can use it in the stock market. But you can gain money and you can also lose money. So there's potential to actually lose money within your policy. Now, if you're paying this thing for 10, 20, 30, 40 years and something bad happens, you lose a bunch of money, guess what? You're going to have to cover the premiums that are ongoing. And premiums can, depending on the insurance policy, premiums can change a little bit with some of these. But I really want to dive into the index universal life and the whole life. Index universal life is a very, very popular life insurance product right now. I believe it's the number one that's getting sold. It seems like every agent I run into selling these things, and I'm running into a lot of clients that either have bought them, or they're about to buy them, or they're talking with an agent and all that kind of stuff. One of my first policies I almost got was almost an index universal life, and sometimes they're called equity index universal life. But what they're doing, the whole attraction is they'll come to you and say, hey, it's just like whole life, except you can do the stock market. We do the index. We do the S&P 500 index, and there's a ceiling and a floor, meaning if the index makes a ton of money, you might make 10%, even if it makes higher than that. However, if the index loses money, if it loses 20%, you're going to make 0%. So there's a floor. So they say, hey, look, you can't lose money. But, there's a little bit of the top you're going to give, but you're still going to make a lot of money here. And then they illustrate, and sometimes they get in trouble for illustrating too much, but they'll illustrate the numbers look great with compounding and all of that. So we're going to talk more about Index Universal Life here. But remember, part of this is a bucket of cash, and then there's kind of like a renewable term. Now, a lot of these policies, I'm thinking the dangers are the long-term effects, because you get into these things for the rest of your life. So what you do today is going to affect you when you're retiring, when you're 40 years from now. So a lot of agents don't tell people the true facts here, because most of these policies, especially when you read the fine print, and I've done it, is the life insurance company says, hey, we guarantee we won't raise the premiums for 20 years or something like that. So what does that mean? In 20 years from now, you're older, you're more expensive to insure. If the premiums start going up, and then say the market gets hit and you're making zero, if you make a 0% for a couple years, I mean, that's very destructive to this that's trying to stay balanced. So I won't go too much more into that because I'm going to hit that last again. But now let me hit whole life insurance. Now, whole life insurance is what we're doing here at ADPI Insurance. We call it our cash flow accelerator. You might have heard those terms. Whole life insurance also can be bad. And if you go look online and Google, and you'll see folks like Dave Ramsey or whoever, they're saying whole life is dumb and you should buy term and invest the difference. Whole life insurance is just a product. Any agent that's trying to sell you a product can maneuver and do different levers. So most of the products out there, most of the whole life insurance products out there are not that good. Now, you have great guarantees. One of the good things about whole life is you know exactly what you're getting into. You got guarantees long term. I think it's a much more secure product. However, a lot of people sell these policies where you'll put some money in and there's no cash value, and cash value is the key thing that we use, but there's no cash value for a couple years, and then it trickles up a little bit, and you got break-even points 15, 20 years down the road. It just doesn't grow much. Well, those are the policies that the Dave Ramseys or Susie Ormans are describing when they say whole life is horrible, and I'd agree with them. And it took me a while early on to figure out what was going on, because look, just as many people that say they're dumb, there's a lot of wealthy people that use them every day. So what I found was it's how you create these policies. And that's with an agent, that's with a insurance company, and what they allow the agents to do. And that really matters, because the way we're setting these up, our cash flow accelerators are all about the cash value. Now, these are still life insurance products, and it's not that we have a love relationship with life insurance, but it's a vehicle that we're using. It's a foundational vehicle. It's a savings vehicle, but then we're using it. The key word, the operative word is using it. What I say by using it is we're accessing collateral against our cash values that go into our investments. That's why we don't like the IUL type setup, because we want our foundational money not to be tied to the stock market. That's the whole point. We want to protect it. This is our fortress, because our cash value grows in these policies every single year. Even when you have a line of credit or collateral against it, it's our money's working in two places at once. Now, I'm not going to get into that right on this video, or else it would be much longer than it needs to be. I do have other videos on it. I love talking about it. I love sharing it. You can even set up a call with me later if you'd like. But I just want to make it very clear what we're doing. We're not doing the average policy that people are talking about. All right, now, warnings. And this is very serious, and it drives me up the wall. This is Derek's opinion. This isn't to throw shade at any other product. We could just as easily sell what I'm about to talk about. But the warning I'm going to give you is on IULs, Index Universal Life products. These are sold. They're the number one sold product right now. They make a ton of money for life insurance companies. Is there a use for IUL products? Absolutely. I talked to some agents. I talked to an agent once. He used it for an estate planning practice. The people are already older. Absolutely. I'm not saying there's zero use for them. What I'm saying is if you're trying to do what we're doing with our whole life policies, that we're making our money so efficient that we're creating our own banking ecosystem and that we're building legacy we could pass down. We can get policies on our kids, our spouses, and that can be cross-generational all the way down. If you're trying to do that, I would not do an IUL policy. And the reasons are very simple. Whole life, you have guarantees and you know exactly what you're getting into. Now, whether you have a bad policy or a good policy, you know what you're getting into. So what I do, and the only way I can really show this is when we compare apples to apples. So I've had clients, we have clients that have had IULs, or they're talking to an agent, so they had some numbers, and we compare, we read through the illustration and what it says. As you get older, most of these companies, they can change your premium. They can increase your premium. Okay. That's a massive thing because we want to live long lives and live into our 80s and 90s. Well, what if they raise our premium so high that they start dipping into our cash value, which we're supposed to be using, right? But if you use it with IUL, you can still take loans, but it's a totally different setup. And if you have loans with that, your money's not exactly working in the same way and the same efficiency that we're doing with our whole life policies. But if your premium goes up, your cash value could be used to pay the premium. But what happens if you're, 85, 90 years old, your cash value is depleted, and you get a letter from the insurance company saying, all right, Mr. Jones, you're paying $2,000 a year, or you've been paying, maybe it's gone up to $5,000 or $7,000 a year, but look, you're out. We need a $20,000 check to keep this thing alive for next year, if you want to get your $500,000 death benefit. Well, now you're jammed up. And what I hate is that people's policies are imploding. Now, we can go back to those variable universal lives. That there's periods of time, like in the 80s when interest rates were real high. These life insurance agents were selling these things like hotcakes, and they were illustrating the paperwork that they give you to say, oh, look what this is going to do. And they were illustrating these crazy interest rates. Well, if you're compounding at a very high interest rate, I don't care what you do, for 30, 40, 50 years, it's going to be huge. But then the interest rates dropped. Then there were issues. There are market issues. There were back of the variable, you can lose money. There were market issues. A lot of those policies, fast forward 20, 30 years, are starting to implode. And this is all information that you can access. The IULs, the Index Universal Lives, as best I could tell, they came out about the late 90s. You're talking less than 25 years ago. And I'm afraid these policies could also implode because the costs are going up and the policies aren't producing what the agent showed them on the paper. And the agents aren't bound. You can't go after the agent and say, oh, the paper is different. That's not how these work. There's a lot of fine print that says the life insurance company can increase all this stuff. And let's show you some news articles. And instead of reading it, I'm going to go ahead and show you. Take a look. And it goes on and on. And these are big deals. The regulators are starting to figure this stuff out. So the good news is, and we've done these before, there's what they, under insurance rules, you can actually transfer into another policy that's called a 1035 exchange. The 1035 exchange is taking cash value that you've already accumulated, and then if you start a new policy, they'll bring it over to the new policy and they'll close the old policy. Now, I am not saying to go ahead and do that. Every single situation needs to be looked at. So I'm not saying everyone needs to switch over and all this stuff or freak out. I think it's best to have a conversation about it. I'm happy to do that. You're not obligated to, of course. So, but that is a way out if you feel like you got kind of bamboozled a little bit. The other thing is, look, if you want to know more about our whole life insurance policies, our what we call our cash flow accelerator, and we have a whole network called Bankonomics that we're teaching people that are our clients how to use these things. Feel free to hit the link below, or at least type it in. Go to the site. You can schedule a call. You can watch some videos. And we are happy to talk with you. At the end of the day, this isn't for everybody. We just want to help folks. This works really, really good. It complements investing, especially real estate and other investments, very well. So all that said, I wanted to give you this overview. If you have questions, please put them in the comments. I do check these comments. I'm happy to engage with you. Even if you disagree, a lot of people disagree on this stuff, and that's great. I love talking to people that disagree on it, and we'll go from there. Have a great day.